Well, good morning, everyone, or good afternoon, depending on where you are in the world. It's nice to start 2024 on a relatively positive note, and I think there'll be some interesting information today, just in relation to some of the latest data, which has caught a lot of people, I suppose, by surprise over the last year or so, or perhaps even slightly longer, since since the beginning of 2023. But it's proven to be, I think, a fairly fruitful year for most property investors, and certainly for most owners of growth assets, full stop. So look, without too much further ado, let me go into this and go through some of the finance data, I guess all of the things that impact upon people's ability to make informed choices when they're looking at the various property markets around Australia. So here's a disclaimer. Please, everyone, have a read of that. This is general information and not personal advice. And just as a bit of an overview for viewers that don't know us, we have a number of discrete businesses that assist people with different parts, I suppose, of their financial services needs. Wise Guru is the international consulting business that helps Australian expats around the world and helps them with some of the other things that those other businesses do. So if you look at Aussie Loan Guru, as the name suggests, we help people obtain loans domestically in Australia, obviously for their property purchases, for homes and investment properties. But more importantly, also we assist Australian expats around the world, and we have some very, I suppose, beneficial offerings that we can give to our clients, where if they're earning foreign incomes, as expats generally are, we can give people up to 85% loan-to-value ratio loans without having to pay mortgage insurance. So that's something that's obviously really important for Australian expats, because it allows them to compete with the local population in Australia when they're trying to build their own investment property portfolio. Aussie Property Guru is the Australian real estate business, and Unicorp Partners is the financial advisory business, which I founded over 35 years ago, and which sort of stemmed from helping my colleagues, young medicos, into the other professions, and then mainly into the banking and finance sector, and again to Aussie expats in all various fields around the world. So that gives you a bit of a snapshot, I suppose, of the different things that people can avail themselves of. And some people choose all, and some people choose one. It just depends on your own specific needs. So, whether you're a surgeon in Sydney or a banker in New York, we find that most of our clients have a similar demographic. They generally earn higher incomes. One of the big problems is that they're very time poor, and I'm sure most of you people on the call would recognise that. They'd like to generally add real estate into their investment portfolio at some point in time to provide a sort of more ongoing stability in their growth assets. And they'd like to make informed decisions, be tax efficient, and they generally haven't got the time to research all of these things themselves. So we provide a concierge service to those people that want that, and we charge $4,950 for this at the end of a transaction. So when just get that up for you, when people look for us to assist them here, when a property settles that we've helped go through the process for, that's the charge is 4,950 Singapore dollars at settlement. So let's now look at the things that I suppose are important to all of our viewers, and should be important to anyone, I think, considering investing in property. What are the most common questions that we're being asked? There's been a bit of a change, and I suppose one of the main ones is now people are saying, well, look, when is the Reserve Bank going to start cutting the official cash rate? So again, there's been lots of discussion in the media, and this can change very rapidly from 1 week to the next, depending on the latest data set that's come out. So if we look at what's happened recently, though, most of the rhetoric in the last couple of weeks, at least, has gone from, some earlier than expected rate cuts, both from the Fed in the US and potentially the RBA in Australia and other developed economies, central banks, to now being pushed back because we've had some strong labour prints and other data sets that have come out. But if I have a look at this, and we look at this constantly, that changes, as I said, from week to week or day to day sometimes. And I think what generally happens, and what history has shown me, is that the sort of Goldilocks scenario of a soft landing that's being priced into many growth assets, equities around the world, etc., is actually pretty difficult to come by. So quite often, central banks will either raise rates too far or keep them high for too long, and then all of a sudden things start unraveling. So, the strong employment prints that we've seen all of a sudden start caving in, and central banks have to scramble to try and stimulate the economy at those times. So anyway, I suppose I'll come to it in greater detail lately, but I believe that, the RBA will probably start cutting rates in the September quarter. Another question we're still getting from people now is, should we fix our interest rates now? And a lot of that's driven by, obviously, the increase, or the rapid rate of increase we've had in the official cash rate in Australia. And people really, I think, are getting squeezed. Mortgage holders are getting squeezed in terms of their mortgage repayments or their investment loan repayments. And so they're sort of frightened and saying, well, should we fix our interest rate now? And I think common sense should prevail here. And it would be, I believe, potentially a little bit foolhardy to fix rates when most people would agree we're going through the peak of the interest rate cycle at the moment. So for most of our clients, we'd like to say to them, well, let's stay on variable and see how things progress over the next few months. Then the other question that leads into that is, how current high interest rates going to impact property prices? And I suppose the best way to answer that is to look back over the last 14 or 15 months. We've had a look at a massive rate of increases very rapidly, and see what that's done to property prices. On a more strategic viewpoint, I suppose, people asking the question about, work from home, because again, the media is coming up with opposing arguments, so certain employers are basically forcing employees to go back into the office, and other employers are saying the opposite and saying, well, look, we could keep this going longer term and have work from home as a hybrid situation maintain itself. And I think there's obviously some scope for both sides of that, depending on what profession or what job you have, because pretty hard for a surgeon to be working from home, yet somebody in another field could do that quite readily. So room for both, but I think it is going to impact the commercial real estate sector, particularly the office sector, and we have to be aware of that. Will rents continue to increase? Again, I'll come to that, but I believe they will. And then population growth. We'll come to some of the numbers there, because Australia's had a massive increase in population over the last 12 months. So, it's pretty important to do research when you're looking at a country as large as Australia, because the various markets are reacting and acting in different ways. And I think this year is going to be one of those times when it's really, really important to start looking at research, because it's not going to be a vanilla one-size-fits-all equation that comes to pass. So if we look at the data sets that we get, obviously we look at different suppliers. The Australian Bureau of Statistics is very important, CoreLogic, Urbis, Oxford Economics and so forth. And they're all providers of some pretty good data nationally. But again, I've found through experience that it's really important to be able to overlay your own experience over that to try and come up with a meaningful outcome, because there's some people with high intelligence out there, quants and other research analysts that look at just the numbers, and they're usually the people that get things terribly wrong, which the last year or so has shown, to be honest. So interest rates, when will they come down? Great question. So at the February meeting, as you probably know, the RBA left the official cash rate on hold again at 4.35%. And I think that was somewhat of a foregone conclusion, although there were still, people in the media saying they thought that the RBA should raise rates perhaps another 25 basis points. I totally disagree with that. But anyway, the RBA remained on hold, and I think will continue to do so at this stage. And then it's really a question of potentially, when will rates start to fall? And I think that will probably happen, as I said, in the September quarter in Australia. To be shaped to some extent by what happens in the US, because, the US economy and Fed are obviously of massive importance when we're looking at global economic events. So when we look at interest rates, it's important to realise now that most banks' official borrowing rates are close to 10%. And then it depends on how much of a discount borrowers can obtain on that as to the actual rate that you're paying. So, you may be paying 6%, let's say, for your home mortgage, but that's had potentially, over 3% of discount built into it for you as a borrower. And rates are still remaining high. There's a bit of flux going on now. So some banks, I've noticed, starting to cut some of the longer term fixed rates. And that's been a change in the last couple of weeks. So before that, they were trying to raise those. And then other banks are slightly increasing their variable rate. And we're only talking, 10 to 15 basis points. So this is not of any major significance. But it's important to now look at how the banks, I suppose, are jockeying for market share, and also what their internal economists are predicting in terms of where rates are going to go over the medium term. I think we're all aware of the actual rates that people are paying, and it's certainly elevated now, and I think it's having more than a desired effect from an economic viewpoint on certain sectors of the economy, and I'll come to that in a moment. So we've had this slide up for probably the last 3 reviews because it's very pertinent. And as you can see on the left-hand side there, Westpac's numbers, virtually, all of their fixed rate loans will roll off by the end of this year. The numbers are already very significant, as you can see there, over 70%. But that's just the tail end of things. And most of our clients, most borrowers who have had fixed rates have already run off, and a lot of those, if they were on home loan rates, were around 2%, now paying over 6%, or investment loans at 2.5%, now paying over 6.5%. And depending on which bank you're with, you could be paying 7.5%. So really important. And it just shows, that sensitivity that the Australian economy has to the change in rates, because most borrowers in Australia have variable rates, as the chart on the right shows, whereas, for example, in the United States, most borrowers have a 30-year fixed mortgage. So over there, it's quite different. If they borrow at, say, 2 or 3% and rates are now 7%, they're not going to buy a new home. So they're going to keep their existing mortgage and stay there. So the transmission mechanism is quite different. So if you have a look at this, this is mortgage rates in Australia have increased more than other countries, and the household debt in Australia is also at a record high. You can see the trajectory there of the effective rate that people are paying, and you can see the US, even though rates have increased massively in the US, that transmission hasn't occurred to most retail borrowers. But if you have a look at the chart on the right, and this is important. So what this is showing is that currently households, and we're talking all households now, so it's important to note that in Australia are spending about 10% of their income, their household income, on just the interest component of that debt. But if we then take out the households that don't have a mortgage, that number, I think, is more meaningful because, as we know, about 1/3 of Australian households have a mortgage. So the other 2/3 don't. A third don't owe anything, and another third rent. So, and that's, I think, the important issue here to look at. and see that, this increase in interest rates is really impacting a certain demographic of people that have borrowed money to buy their homes or borrowed money to buy investment properties. And they're the ones that are really feeling this, whereas the other demographic, and we look at some of the numbers from the various banks, and they're usually an older subset, so people over 55 and over 65 who tend to have cash on deposit or cash in their superannuation funds, are getting more and more income on those assets in terms of interest and are spending that. So a lot of the services inflation that's proving to be sticky, I think, is potentially as a result of this. And that's, these people, the subset of the community, having the capacity to spend a lot more money. This is just Westpac's forecast in terms of, where the cash rate's going to be. And they're, also saying that they think the RBA will remain on hold and start cutting in September. I think it may actually be in the September quarter, so maybe prior to then. But the trajectory of that, as we can see, is for some reasonably significant cuts to come through over the next number of quarters. And again, I think this really changes. Anyone who follows financial markets just needs to look at the bond markets and the amount of volatility that's occurred there over the last 3 to 6 months in the US, in most developed nations, in Australia, is extraordinary. I've never seen anything like it. But look, I think that's the other part then for our Australian expat viewers, obviously. What happens to the exchange rate is of importance and can be of great value. The Aussie dollar has languished currently, and I think there are a number of reasons for that. Some commodity prices have languished, others have gone up, but pardon me, it's more to do with what's happening in the US and when the Fed's going to cut rates there and by how much. And I think that will start to unfold. So when we do our next quarterly review, I think we'll have a far better picture in terms of what's going to happen there. But we can see the Aussie dollar at the moment is, sort of about 65.5 cents today as we speak. And this is Westpac's idea of what's going to happen versus the US dollar. There'll be a gradual appreciation of that currency pair. A lot of our clients are dispersed around the world. So I think whether you see, a short-term or a medium-term increase of the value of the A dollar, or indeed, if a black swan event occurs, you could also have a fairly market downturn that's, I would have thought, perhaps short-term. So lots of possibilities there, but I think it's more important to act on what's known and what's in the market. So if people are looking to purchase something in Australia and they need to transfer some funds from overseas, it may be an opportune time to do that in tranches and start moving some of those funds across whilst they're getting the benefit of that FX tailwind for their investment. So this is something that's brought out by Coolabah, and I think it's it's interesting. 1 second, bear with me. Yeah, it's interesting because it's a pretty much data set and quant driven asset manager in the fixed income space. Some highly intelligent people there, and they're looking, I suppose, at what interest rates do to property prices globally. And in reality, I mean, as history has shown us over the last year, residential housing isn't as impacted by that as many other asset classes. So it's probably somewhat foolish to look at it just in that manner. It's something that people use to live in. And clearly what's shown by that graph is that in most developed nations, that asset has continued to increase in the face of rapidly rising interest rates. So I think that's a good lesson for everyone to look at and learn. It's something that, we spoke about at the beginning of the pandemic. and were completely correct on. And I think people lose sight of that in economics. So I think it's important to recognise that and see that it's not just interest rates that drive housing costs, it's supply and demand, and it's people having access to funds. So what we're seeing in the Australian market certainly is that lots of higher end, high quality, expensive housing is being purchased by people that require perhaps a small loan or none at all. People do have the cash, and there's been a big transfer of wealth also that's starting to unfold between generations, and that's going to continue, and I think will continue to have or provide a tailwind for that sector. So it's important, again, research, look at what you're going to invest in or buy to see how that may perform in the future. As most of our viewers from the years know, population is a pretty important thing in relation to housing. So if you've got a population that's growing quickly, you need to be able to give them the supply to live somewhere. And again, this is always spoken about so generically in the media that it just astounds me, because if Australia needs, for example, an extra 120,000 homes that the government says they're going to build over the next 5 years, I don't know how, but where are those homes going to go? And do the people that are moving to the country or just through organic growth being born, etc., want to live in those locations? And in many instances, the answer is definitely no. So I'll come to all of this, but it's interesting because if you look at what's happened to Australia's population, it's grown at nearly 625,000 people in the 12 months to June, so the latest ABS data. And that's a very strong increase, 2.4%. Massive amount of overseas migration. A lot of those are probably temporary visa holders and students, so they're going to move mainly to the capital cities, mainly the East Coast capital cities in nominal terms, and they're probably going to rent, and they want to rent somewhere, I would say, close to universities. So look at all of these things, but look at it and with a bit of an open mind and be more granular when you look at these things and see the impacts that this may have on demand in certain areas. This just gives us a bit of an indication of actual numbers of people, that are moving to and from various states and territories. And if you look at this here in the bottom right-hand right-hand screen, Western Australia's had the fastest rise in population over that 12-month period, 3.1%. It's a great increase, followed by Victoria and Queensland, 2.7%, 2.6%. Again, very strong rates of growth and different again for each state. So WA started from a low base and now keeps growing, and it's really growing strongly. Queensland's had strong growth for quite a number of quarters, and Melbourne had a pretty sharp dip during the pandemic and is now rising again, which is great for for people, especially in Melbourne. If we look at new lending, that's what we do, because I think it's not a bad data set to look at to see what's happening in the markets. And it declined in December, 4%, just over 4%, 26 billion. But that was driven by a 5.5% decrease in first home buyer financing. So, what does that tell you? And I think first home buyers are probably struggling with the higher interest rates more than other parts of the population. Investor lending declined 1.3%. And again, depends. These are generic numbers. So if you look at it state by state and market by market to see how that's actually panning out around the country, there's some great variation amongst that. But overall, if you look at those numbers, then I think you can see that, that lending is at a higher level than the longer run average. And you've seen that uptick here, even though we've had a small downturn in December, the trajectory is still up. So people are still looking to leverage to invest in residential property. This is something we look at because the banks look at it. and what they consider, when they're looking at their risk management criteria. Risky loans, what are risky loans? So they have different measurements of that, and basically, a lot of them look at loans over 80% LVR or loan to value ratio, or over 90%. Are loans interest only, or are they principal and interest? Then they put it's an arbitrary number, but a loan to income ratio of more than 6 times. They're the sort of metrics that banks look at in terms of how they classify those borrowers, those loans. And as you can see from these graphs, all of that's been trending down for quite a time now. Certainly over the last 2 years or more, we've seen a decline in the riskiness of lending that Australian banks are undertaking, and I think that stands everyone in good stead in terms of the banking sector being in a good, sound, robust position. So let's have a look at property, and I'm speaking about residential property as an asset class, because it's over $10 trillion in Australia these days. And as you can see, if you look at, commercial real estate's 1.3, so massive difference. And when I speak to people, most of our clients tend to have some form of leverage, whether that's for a home mortgage or investments or whatever, but they all think that everyone has a loan. And those numbers will show you that, the outstanding mortgage debt is 2.2 trillion. So 8.1 trillion of assets that has no leverage against it whatsoever. And I think that's important to recognise, and comes back to what I said earlier about, many people buying these assets and either taking a small amount of leverage up or none at all. So worth bearing in mind. Now this is the what's happened to the end of January in terms of national home values. And again, this caught most people by surprise. But if you look at an annual basis, 8.7% growth, which was very strong growth. The quarter, 1%. So I think, thankfully, certainly for property buyers, the rate of increase has slowed. Capital cities up 1%, regional areas up 1.2%, so increasing a little bit more rapidly in the last quarter. But again, these are the overall figures. So, we're not buying an amalgam, we're buying a property in a certain market. And that's where I'm saying it's really important to look at the research. And I'll show you how, if you look at that, look at the 3 months change in dwelling values. And if you look on the left-hand side of your screens there's a massive difference. Look at Perth, Adelaide and Brisbane, as opposed to Hobart, or Melbourne, that have had negative growth, so have had declines. And I think if you look at, combined capitals, they tend to be slightly more volatile than the regionals, although, again, the pandemic changed all of that. But, some pretty robust growth all around. And then if you look at different segments of the market where we go, become a bit more granular again, so upper, middle and lower bands of property values, you can see that in Perth, Adelaide, Brisbane, all 3 of those have had very strong increases. Melbourne's had a decline in all 3 bands. Sydney in the upper quartile. Hobart's been negative for a little while now, and sort of fairly line ball for Darwin and Canberra. So this is what I'm saying. Have a look at this graph. Dwelling approvals fell nearly 10% in December, and that was driven by 22% plus decline in unit approvals, and they continue to trend well below their decade averages. And I think this is where high interest rates, land values, construction costs, access to labour, to the trades, are continuing to contribute to this low application level and low supply. And I've never seen it as tough as this, because most builders and developers that we speak to are finding it extremely difficult to try and put a feasibility together for a project that actually works. So clearly they're in business, and most of them will say, well, if we're not going to be able to make a profit on this, then we're not going to build it. And as you can see, the orange chart here, I mean, you know, we've got a fairly important issue here where this undersupply is going to exacerbate, I suppose, the shortages in the market as we have ongoing population growth. And that's something that, again, if you utilise the data well, should be able to help most people make some reasonable choices in terms of what their next move is going to be. This is another sort of graphical representation of that, you know, of that undersupply. And I'm not seeing any change in that at this moment. So the only thing that can make builders look to build more dwellings realistically is if you have a situation where prices keep going up, or interest rates keep coming down, and potentially, you know, the thing that's going to happen is a bit of both, which will enable some more new supply to come to the market. But again, very importantly, it's really a case of a lot of that new supply is going into what they call these growth corridors, greenfields areas that may be 40 or 50 kilometres from the CBD of a major capital. So a lot of people just don't want to live there or can't live there. And the market's going to be pretty tricky for a while, and I think offer some pretty good opportunities for people that spend the time trying to make a well-informed choice. So what's happening to the rental market, or, you know, what's going to happen? Lots of our viewers who are property owners, whether they live in Australia or overseas, they own Australian property, and they've seen a very significant increase in their rents, generally speaking. So, you know, is that going to continue? And I think, yeah, look, if rates are going to stay higher for longer, then I think rents are going to stay higher for longer and increase as competition for that supply intensifies. And all you need to do is go out and have a look in the marketplace at what's happening if you're actually trying to rent something in, you know, whether it be Sydney, Melbourne, Brisbane, Perth. It's pretty tough and it's very expensive. So that offsets the rise in interest rates to some extent, although certainly not fully. But one of the things that does change, and you know, we've now had an amendment to the stage 3 tax cuts that were legislated in Australia. It's going to increase the amount of negative gearing benefits that property owners are going to receive, because there'll be a greater loss created, and thereby property owners, income-producing property, will be able to claim more benefits and get more back from the tax department. So many things at play here, as with most things in an economy, lots of factors. But if you look at rent values themselves, nominal basis, they increased 0.8% in January, taking the national increase to 8.3%. And, you know, that's, again, an amalgam number. But if you look at certain places, rents have gone up 20%, others, rents have gone up very little. So really depends where you are. If you have a look at the major capitals here, you can see Perth up 13.4%, Melbourne 10.7%, Sydney 9.7%, Brisbane, Adelaide 8.3%. So, you know, some pretty decent increases. But if you have a look at regionals, you'll see far more variation, from regional New South Wales at 2.4%, regional WA 11.8%. Worth noting that, you know, these increases have come from a very different base value. So regional WA and regional New South Wales had a very, you know, very much different starting point in the actual rents 12 months ago. Then if you look at it on a national basis, I mean, the gross yields have moved slightly higher nationally over the last few months, and that's been driven more by, you know, capital values, how they've moved over that time, 3.3%. But again, you don't rent a national building. So if you have a look at Sydney, 3%, you know, Darwin, 6.5%. There's a great deal of variation. And then there's, you know, a great deal of variation within markets. So if you have a property that's in high demand and, you know, there's not much supply, clearly the amount of asking rent that you can achieve is far higher than, say, the suburb average or the city average, etc. So, you know, when we look at all this data, what does it tell us? What do we do with it? More importantly, and how can we help people with it? Because as we all know, or should know, there is no Aussie property market, even though I get asked this all the time, especially from overseas, you know, oh, look, what's happening in the Aussie property market? Well, if you look at that map, and it's sort of, I suppose, designed to show a little bit of insight, but, you know, if you're in Perth or Brisbane or Hobart or Darwin, things are really different. And that's the important thing to recognise and start from there, saying that, look, there is no Aussie property market, so we need to look at lots of them. Now, this is something that I've shown over the last couple of reviews, and what's happened to housing prices during tightening cycles has been quite mixed, because, you know, we've had a lot of the, I guess, quant commentators, economists come out and say, well, look, rates are going to go up, so prices are going to come down. And as we can see by that, you know, both things can happen during tightening cycles. Certainly, we've had such a massive increase, and it's happened so quickly, especially in Australia this time, that it has had an impact, clearly, some headwinds there, but not nearly as much as people thought. And I'll give you another indication. If we have a look at, I'll come to it in a second, in terms of what prices actually have done post the last cut. It's pretty important to recognise too. So if we look at activity, and this is something that, you know, I looked at over 18 months ago, I suppose, and certainly at the beginning of the pandemic, that sales activity would slow down significantly, and it did. But if we look at what's happening now, then these figures are from CoreLogic, you know, just under 500,000 sales in the 12 months to January, and that's running about 3.5% above average annual volumes over the last 5 years. So there's been good turnover. So that means there certainly has been a good amount of stock that has come to the market over that 12-month period and has been absorbed by the market. So I think that's the important thing to recognise, because, you know, a lot of people thought, in hindsight incorrectly, of course, that they would wait, and as these fixed rates rolled off and this mortgage cliff, we don't hear about it anymore, but that was a big phrase not long ago, comes to pass, that there would be all of these distressed sales, and they were going to buy things at, you know, 30 or 40% under market value. So these numbers obviously show us that that's probably not likely to occur. So you need to look at other things if you want to take advantage of what's actually happening in the actual market as it exists. And if you look at things here, monthly sales volumes, I mean, you can see this massive downturn. Now, if you're looking for a property, you think, oh, wow, this is fantastic. Fantastic news. However, that's really a cyclical event, and you'll find in January every year in Australia, you know, not much happens. So that's more as a result of that rather than anything of consequence within the market. But if you have a look at the changes in sales volumes, Sydney's kicked on, you know, over 11%. It's been pretty strong. But that's also being absorbed, which is the interesting part. And then in other of the smaller capitals that are showing greater rates of growth, as you'd expect, you can see there's been a decrease in sales volumes as less people are selling, and that's obviously favouring the sellers. So you've got to look at all of those things, and depending on where you want to buy something, how that may impact you. Now, this is a slide I was referring to, and it is what happens to, or what has happened to house prices after the last interest rate cut in whichever cycle. And if you look at that here, this is a set after 1 year. So in 2010, when we had that downturn, -4%. In 2008, -4.5%. In 2000, +14%. And in 94, pretty well flat. So bit of volatility in what happened over the last 12 months after that. But then if you look at 2 years, you can see that it's been a reasonably positive outcome in relation to what happens to housing prices. And more importantly, after 5 years, you can see what's transpired in all of those cycles. So, you know, who knows when the first rate reduction may eventuate, as I've given my opinion, but I think November was probably the last rate increase in this cycle. I think we're at the peak of that. So if you look at what's going to happen in the 12 months to 2 years after that, that gives us some historical data that we could look at and perhaps say, well, these are potential outcomes. So as we've said to our clients over many years, what's really important when you're investing in property as an asset class, and I'm talking about residential property, it's easy as pie: population growth, infrastructure growth, and employment growth. If you have those three key fundamentals that are already existing in a market or are going to and are going to prevail over the longer period and sustainable, you're going to end up with a really good outcome as long as you buy a quality asset. So if we have a look at the various, let's look at some of the states, so capital cities in those. Sydney, New South Wales, still the most diversified, strongest economy in the country. But I think now, when I say highest downside risks due to affordability, in Sydney, people are having to spend a substantially larger portion of their household income on occupation costs. So whether that be a mortgage or rent or whatever, and I think that is an issue, and that's going to potentially, I think, slow the growth in that market, hopefully for people who are looking to buy there. But then we've still got to contend with the people that are not borrowing. The ongoing demand for quality has been there for a long time. I think will always continue to be there. As we can see in the moment, the quarterly price growth has slowed, thankfully, but immigration remains really strong, and a lot of those people are moving to Sydney, Melbourne, Brisbane, Perth, etc. If you have a look at it here, over the quarter, Sydney values only rose 0.1%, so pretty flat. But over the last year to January, it's nearly 11.5%, so a very strong rise. And then if you have a look at Melbourne now, again, Melbourne's always been very strong in terms of providing education to offshore students, and they've had a really big boost to immigration, especially in that sector. Rentals there still remain very affordable compared to other capitals around the nation. But interestingly enough, in the quarter, we saw a decline in prices. So, if you have a look at this, over the quarter, Melbourne was down just under 1%. And if you look at it over the year, it's only risen 3.9%. So 4.2% below the record high in March 22. So it's been a different story totally to Sydney. Now, if we look at Perth, I mean, that's had a fantastic run over the last year. Strongest annual capital city price growth, rental growth, highest population growth. So, I think if you're a property owner in Perth, you're finally going and saying, look, this is great news. And it is. Over the quarter, prices were up nearly 5%. 16.7% over the last year. They're at a record high, clearly. But I mean, that's been terrific for people owning property there. Clearly more difficult if you're trying to buy into that market. Rents obviously also very expensive on a relative basis. So what's good for one set of the population may be bad for another, and it's always been the case. Now, this is a question we get asked many times, when I'm looking to buy a property. Should I buy an old one? Should I buy a new one? Well, there's no empirically correct answer to that. If you are looking to buy an older property, perhaps you've had some experience, you've been in the construction sector, or you've had some other experience at how to add value to a building, to a property, or you may be nearing retirement. You might have extra time on your hands where you can do that. So you could, renovate, etc., redevelop and add some value to that property. And I think that's a very sensible thing to look at. Certainly for most of our clients, they're unfortunately not in that bracket because they're very time poor, as we said. And certainly if you're living overseas, then it's pretty difficult to do all of those things. And quite frankly, it's difficult to outbid professional builders or developers these days when trying to obtain something like that. So for most of our clients, new dwellings tend to be a better solution, especially if they're built by builders that have a good track record of providing, high quality. So you don't have repairs and maintenance to worry about. You've got warranties and insurance. You tend to get better tenants, and it's easier to rent and manage those. We find most of our clients would like a no-touch solution, which obviously doesn't exist. But if you can make it low-touch like that, you don't have to deal with property managers or tenants. It's a much easier investment investment to deal with. So the added benefit, I suppose, in Australia is that we have a unique set of non-cash deductions available through Division 43 and Division 40 depreciation allowances, so capital works and fixtures and fittings, and you can offset that against other Australian taxable income. So if you're in Australia, against your wages or salary or other income, and if you're a non-resident, so an Aussie expat, then you can offset it against the rents that you're getting from your properties in Australia, any other Australian taxable income that you may have, and save the tax credits that you can't utilise till later, or perhaps when you repatriate, and make that transition back into the Australian tax system far more manageable. It's pretty useful. Just ask any Aussie expat that has returned recently to Australia, and they'll give you a pretty good indication of how to utilise those. So, whoops. What's the data telling us? And it's been telling us this for a little while now. As most people watching this will probably know. Where should investors have a look, focus on? And, at this point in time, I think Southeast Queensland still probably offers a really good entry point when you're looking at residential property. The value gap between say, Sydney and Brisbane is still massive, and it's grown in nominal terms. Those values have increased in both capitals. It still exists for Canberra and Melbourne also. And I think the other benefits there are, what we've seen since before the pandemic, and that's people moving to that Southeast Queensland corridor for lifestyle reasons. So not only do you get more bang for your buck, if you sell up in, or did then in Sydney, Melbourne, still now, you can move to Brisbane, get much more value for that capital, probably have some money left over, and then have a cheaper living cost in terms of educating children, etc. So the interstate migration into Queensland has been running at, sort of 15, 20 year plus maximum records for the last number of quarters, and continues to do that. And I think the work from home situation also assists there, where people can take advantage of those coastal markets, enjoy their lifestyle, and still manage to do their jobs, whatever profession they're working in an efficient manner. So the economy is well diversified, and I think the other benefit now is, of course, the 2032 Olympics and what that is causing in terms of infrastructure growth. So if you look at Brisbane, quarterly increase, 3.2% was pretty robust, up nearly 15% over 12 months. Prices there, a record high. So it's certainly been moving in the right direction for quite some time, but it really sped up to a large extent in the last 12 months. And here's some of the, I think, reasons for that. If we look at population growth, and we look at not just, NOM or net overseas migration, but look at interstate. And if you have a look at net interstate migration here, New South Wales, 34,000 people left the state, negative for Victoria, SA, although that's a very small number, nominally Tasmania, Northern Territory, ACT, and the beneficiaries were Queensland and Western Australia. And then if we look at overseas arrivals, clearly the majority of those people would go into, Sydney and Melbourne markets. But Brisbane's quite up there, and then look at Perth starting to really move in the right direction there also. So, some of these smaller capitals, these states are really starting to, I think, see the benefit of having lagged the Sydney and Melbourne markets for quite a number of years. And I think that now is changing. If you have a look at this in a graphical manner, it gives you a pretty good indication. You look at net overseas migration, again, most of that would be going to Sydney and Melbourne there. But if you have a look at all three bands, the net interstate migration is important here in Queensland and to a smaller extent in WA. And I think it's set to continue. So, the Olympics, whilst as we saw in Sydney, it's a short-term event, but the amount of infrastructure that gets built for this, and we see it in Brisbane, on the Gold Coast, Sunshine Coast, there's a lot in the pipeline. A lot of it's been started, and a lot of it's quite a reasonable way along already, but there's much more to come, and it creates obviously ongoing and shorter term and ongoing employment, but also a lot of other benefits. So, things, productivity increases. So you're going to get, better transport hubs, better amenities in terms of all sorts, I suppose, in terms of education, entertainment, the whole set of amenities that people like to have when they're looking to move somewhere is increasing at quite a rapid rate of knots. And anyone that visits Brisbane these days can see that, especially, for example, in the F&B scene, if you're coming from, Sydney or Melbourne. So we'll just put this on. You can have a quick listen to this.
The latest look at what could be Brisbane's Olympic Park in 2032. A floating pool in the Brisbane River, South Bank's Arbour Walk, extending from the Gabba through to the city. What 2032 will do between Melbourne and City. The latest look at what could be Brisbane's Olympic Park in 2032. A floating pool in the Brisbane River, South Bank's Arbour Walk, extending from the Gabba through to the city, urban rainforests lining the water, public transport, green bridges connecting venues like Suncorp Stadium to Brisbane Arena at Roma Street, Brisbane Convention and Exhibition Centre through to the Gabba.
So, as just gives us a brief glimpse, there's a massive amount of infrastructure that's being created. Some of that was started a number of years ago already, but this will only continue right through to the games, and that's adding to, I believe, the whole appeal of Brisbane as one of the major capitals, the third largest in Australia now. And I can say that continuing certainly for the medium to longer term at this point in time, because that, as I said, that value gap, that bang for your buck, is very much to the forefront of people's minds, especially when you have higher interest rates and when you have higher living costs. That's really important. So when we look at all these things, what's the value proposition, I suppose, that we can provide people? And a lot of that comes with tying things together and trying to help people not make the common mistakes that we see being made, continually by people. So if you look at this, buying into a strong market, well, a lot of people buy into a market that's showing massive growth, and perhaps at that point in time, they might want to sit back on that and really buy into a market, a strong market of the future. We see this quite often. You see it in all asset classes, whether that's in equities or cryptocurrencies or whatever. People will tend to buy things quite often at peaks. So they should really look at underlying data to see what's going to happen with certain markets and buy into those before that happens. Now, on the right there is no lack of information or research. It's just that most people these days don't have the time to be able to utilise that. And if you start looking at all the information data, you see there's so much of it that you sometimes can go away, scratch your head and say, well, there's so much information there and a lot of it contradicts itself. What do I go with? And that's where I think, a few decades of experience go a long way. So ignoring your point of difference, that's another thing. People just think, oh, look, I've been wanting to buy a property for a long time. I haven't had the time. I should buy one. And we see that quite often. And again, what makes you think that's going to be a good outcome for you when you haven't actually had the time or the ability to research that for yourself? Any investment won't do. So important not to buy things that are generic and I think lower quality or have lesser attributes than things that have unique attributes. Waiting too long to invest is another great one. People just, through whatever reason, usually it's, oh gosh, we're just too busy. They procrastinate and don't make up their minds and can't make a decision. And then they come back and say, oh, I should have bought that, 3 years ago. So they're the sort of things that we see a lot. Any property won't do. So, whether it's a single theme economy, I'm just looking at Port Hedland there, and, iron ore certainly is a strong one, but the volatility that a market like that's seen has been unbelievable over the last 30 years. A lot of the smaller sort of, and I call them investor style units, that's not investment grade, they're just, small challenge floor plates, generally sold to international markets. So you've got 400 one-bedroom apartments in a massive tower. It's pretty hard to see those having sort of capital growth that you'd be looking for. And the mega high-rise buildings, doesn't matter if it's on the Gold Coast or Melbourne or anywhere, I think steer clear of those. But then we look at further granularity within markets. And this is just, what's happening in Brisbane. We're looking at some potential supply in the inner western suburbs, which is an affluent area. And it's a pretty good indication, though, of what's happening in terms of what's being built or marketed and what's required. So if you look at, the 4-year pre-COVID annual demand was over 5,300 new dwellings. What's coming to the market is just so insignificant compared to that it gives you a pretty good understanding of why we're seeing it's actually happening in the results. And that's where I say it's really important to look at those strong markets of the future, see how you can benefit from utilising some of the data that is actually out there and, certainly available on the internet. This is a buyer preference graph, if you like, something the ANZ did after the pandemic, but we found that's actually going through and continuing on these days, where people want to have larger dwellings, if they are working from home or not. They still would prefer, say, a 3-bedroom apartment if that's what they're going to live in, or a 2-bedroom plus a multi-purpose room. They're also, households are shrinking in terms of size, so you have fewer people living in households, so that's putting other pressure on the supply and demand situation. Regional living is starting to come back to more pre-pandemic levels. So, we saw during the pandemic, obviously people would like to go to the regions because they felt they had more space, more ability to move around. That's starting to move back to more the longer term situation. But I think it's important to recognise that all these things will have an impact on how society operates. And you need to bear that in mind when you're looking to make an investment yourself. So when we try and tie it all together for people, as I said, important to look at that. So I was thinking about infrastructure growth, that's why I was suggesting Brisbane is a pretty good example of a lot of infrastructure growth going in there for that specific project being the Olympics. But, there's a lot of infrastructure going into Sydney, into Melbourne, etc. And that brings employment growth. That gives things future sustainability. Although, also living in Sydney, you recognise that we're pretty challenged there. And just the transport system, I don't think will ever catch up to, how the population's growing in that city. So certain cities have more challenges than others, say like Canberra. But if you're going to acquire a residential real estate asset anywhere in those markets, try and find some unique attributes to that property, because clearly if the quality asset has unique attributes now that are sustainable into the future, that's generally going to mean that it'll be easier to rent, you get a better tenant, and you'll get better capital gain over the long term. And then look for that strong economic activity that's going to grow and continue into the future. So easy to say all those things, but not as easy to find them, especially these days, because finding new supply of quality assets is just, as I said, harder than I've ever seen it. So if you look at opportunities for this year, and as I said, the beyond part is more about sustainability. We find that people still want similar things they've been wanting for the last couple of years, and that's these oversized, high-end boutique style buildings in the inner to middle ring suburbs of the major capitals. Coastal markets are still proving to be very popular, and a lot of people also moving into those areas that are not borrowing at all. So they may have sold their home in Sydney or Melbourne and moved to, let's say, the Gold Coast. And that's continuing to be a pretty strong demographic. The other areas that are that are proving to be really popular, if you can find them, and they're so hard to find, is the high-end townhomes that are situated in those inner middle ring suburbs. So we sort of say 3 to 13 kilometres from a capital city. It's just really almost impossible for builders to try and make these things stack up these days with the increased costs of of labour and goods. So they're really popular. A lot of people like the space, but like the convenience, and it's just supply is so constrained in that type of dwelling. Oversight, we find this, this search for not just oversized apartments, but I think if we look at this, it's also amenities that people are looking for now. So, if they're buying a home for themselves, 3 or 4 bedroom home or 3 bedrooms, multi-purpose room in a beautiful new building, they're looking at things like, the rooftop entertainment areas, pools, barbecues, gymnasiums, wine rooms, all of those things that 10 years ago were really not heard of. They're now being sought out by buyers that have the capital or have the ability to borrow, so they can afford that. They just need to find it. And that's the difficulty, I suppose. There are a lot of people who can afford to buy something now, but there's not the availability of stock to satisfy that demand. So from a financial viewpoint, if we're looking at investment, this has been sort of the generic pie chart that we've seen over the years, who pays for things, and tenant pays for generally around 73% here, the tax office 21%, and you 6%. That's for an Australian tax resident, and that's been the case for quite a long time. So if you have a look at it here, there's a difference if you're an Australian expat, because you're not earning your personal exertion income in Australia. So unless you have other taxable income there, you can't utilise potentially all of your tax credits in the current financial year. So you can only utilise some, which would be to negate tax on your rental income, and you keep the rest of those credits to carry forward and utilise later. But if you can see, that's the same scenario for an Australian tax resident. You can see that it's still a pretty attractive situation where most things, even with these higher rates, can be fairly well neutrally geared these days on an after-tax basis. And I think that's really important when you do your due diligence and look at the numbers realistically. It's really what ends up in your pocket that matters. That's a situation in a graphical sense. As I said, they're non-residents without sufficient Australian taxable income get to spend their tax savings when they repatriate or potentially sell those profits, even though we tell most of our clients, unless there's a very good reason to sell that asset, then why do so? So this, just, I suppose, underscores that, because property is a long-term investment. It's not a speculative tool. And what you find is that if you keep things for longer, you don't have to do anything. If you do the work or get someone to do the work initially, get a high-quality asset in a sought-after location where supply continues to outstrip demand, you're going to end up with a really good outcome. And all you have to do is keep it. So thereby you also save obviously on tax, because you don't have to pay any tax on your capital gains. And you can utilise the equity that you develop over the years to potentially act as your treasury and utilise that equity, borrow against it and buy other assets if you so choose to. But what we find is, as you can see here, most people sort of sell things between 4 and 8 years of owning them, which is potentially not the greatest thing, because if you have a look over here, in nominal terms, certainly if you keep things, over 20 years, that's when you're going to start getting the real bang for your buck. And if you're in the fortunate situation where you have owned a property for, say, over 20 years, that is a quality asset in a sought after market, you'd know yourself what's actually happened to the value of that, or you might have friends that have that, and then underscores what I'm saying. So sometimes doing nothing is a lot harder than doing something, but we'll quite often end up with a far better outcome. What do we do, I suppose, to help people with all of that? Well, quite a few things, but we've been doing this for a long time, over 3 decades. As I said, we can give both our Australian domestic clients and our Australian expat clients 85% loan to value ratio loans without them having to pay mortgage insurance. We can assist people. We have a panel of experts to help you maximise efficiencies from tax, ownership structures, management with those investment properties. So all of that we can cover off with people on an individual basis and try and make this process of making a property acquisition as stress-less as possible. And we offer all of our viewers an ability to at least have a look at that, where we can have an initial meeting, which we won't charge for, and try and see if we can assist you. If we can't, we would just say, look, can't, point you in another direction. But if we can, we look at that, and that's when we look at people's personal situations and go through that with them in relation to not just whatever they want to do in the future, but potentially these days certainly looking at their existing debt portfolios. People are saying, hey, these interest rates are really starting to bite. We're a bit stretched here. What can we do to try and help mitigate this? And that's especially the case for our Australian expat clients, because they're sort of away from what's happening and they need a bit more assistance. And there aren't many people that specialise in that niche. But in Australia, it's the same. If you're a professional person, you haven't got time to do all these things, and you need someone to assist you. By all means, please reach out, email us or phone us, and someone will get in contact with you and see if we can't help you with your own set of circumstances. And if you don't mind, you'll get we'll send you a feedback form if you don't mind filling that in. If you like to add any comments in relation to what you'd like to see at future reviews, we'd really welcome that. We really welcome any questions that you may have, and we try and cover those off on our weekly Q&A sessions, which are posted on our YouTube channel and on LinkedIn. So by all means, have a look at that. And if you like what you see, then click like. And if people have some questions now, then please fire away and ask. Alison, you've been watching there. Have you got some questions for us?
No, I'm all good, thanks. But really comprehensive summary. Thank you. And going to think and might come back to you, but I'll let you know. Okay. Thank you.
I appreciate it. That's fabulous. Thank you. Anthony, how are you there? You enjoying the sunshine?
Enjoying the Sunshine Coast and the investment area of, north of Brisbane. I've got one question. I was looking at how various suburbs with new dwellings have been growing north of Brisbane. I look at Tygum, which is about 14 kilometres out, and there was a 23% growth in median house prices in the last 12 months. Is that suburb within range of what you're talking about for the places where we should consider investment?
Look, it's probably just outside that in reality. But look, everything, as you know, there's no hard and fast rule about this. So it's really then a situation where you look at, what else exists there? What are the other drivers? And that's why it's so important to I guess, look at all of the factors involved, because otherwise it'd be really easy, especially these days with AI. Here are the parameters and off you go and come back with some results for me. So I think it's more a case of, the easiest pie situation as well. What are the employment sources close to there? What's the infrastructure close to there? What's the demographic of the population there from an income viewpoint, kids that they have, etc. So I think there are a lot of different sub-segments of that need to be looked at and then have a look. Clearly, if something's gone up 24% in the last 12 months, there must be a reason for that, and it could also be starting price. So it could be, many things that come into that. And then will it replicate that in the next year or the year after that? Again, have a look at what the likelihood of that is. But
good point.
I think it's probably a little difficult to try and pick suburbs. And I sort of, I guess, compare that to someone working in, if you're, say, looking to invest in equities and you're an equities manager working in the micro cap space. You've got to be able to accept and sustain a fair amount of volatility, because, when you look at specific assets within areas like that, you can obviously get a lot more volatility. So if something goes up 25% one year, it could easily go down 25% another year, not necessarily next year. Whereas certain areas, I think you're going to get more muted upswings, but also more muted downturns.
Right. Fair enough. Yeah, understood. Yeah. I mean, that one is close to the airport. It's south of North Lakes. It's near to motorways. So it does. Let me go and do a bit more research on it. Thanks for the answer.
I think, from what you're saying there, generically speaking, it seems like a good outcome. Absolutely. Yeah, for sure.
Okay. Thanks.
I've got another question here from one of our viewers, and he said, look, now that rates are at 6.5% or 7%, is it actually, worth buying something? Which I thought was an amazing question, because this person's actually a pretty seasoned property investor. And then I think about it and say, well, why would somebody be asking that question, having been in the markets over the last 35 years and, remembering when rates were 17 and 18%, what made you ask the questions at any given point in time? And the reality is, generally speaking, that you're feeling the crunch from a cash flow viewpoint. So I think you need to be careful that sometimes events that are crowding you don't impact your judgment in an incorrect manner. So let's say, you've got whatever, half a dozen properties and you're finding it difficult to meet the shortfall perhaps on loan repayments. Not everyone's in that position. So a lot of people would say, well, look, this is great. In the top marginal tax rate, it really costs me very little to buy this property because I'm only paying 6.5% interest. So I get a lot of that back from when I put in my tax return. So it's really important to view that in a more holistic manner, because otherwise you could shoot yourself in the foot, make the wrong decision based on your own circumstances, and not recognise that there are millions of people out there that may not be in your position. I hope that sort of answers that question in a real sense, because we're getting a few people, obviously households are starting to feel the pinch as these rates have increased and are remaining at these levels. And it's interesting. I was talking to one of the banks just the other day, and we were looking at a client's interest rates, and the variation between principal and interest only was actually quite stark. It was like 6.37% on one and 6.72 on the other. And we look at blowouts like that because, generally speaking, you're talking about 20 to 25 basis points difference. But now it was more like, closer to 50. So they're all things that I think bear on people's minds. Anyone else out there have a question for us? Ricky, Mark? Look, in any event, I think the important thing is, and people know that, send any questions in to us. We'll try and cover those off every week on our Q&A. And I hope you enjoyed sharing the information with me, and look forward to seeing you on the next quarterly review. All the very best.
Thanks,
Cheers
Andrew,
for
very
now.
much.